I've been covering a lot of REITs on this channel as of late, and it shouldn't be too surprising as to why. During a bear market, REITs are going to help you. They're going to protect you, at least the ones that I've covered, because assuming nothing crazy happens, they're going to survive. They're going to give you that nice 5% dividend yield, 5 to 6%. And during a bear market, that's good because instead of going flat, going down, your money's protected. You're getting a safe amount of money. You know what's coming in, at least somewhat in the range. Of course, if they do terrible, they cut the dividend. That can happen during a recession, but just during a flat bear market, REITs are going to do much better than like the average tech stock. Probably much better. Simon Property Group is a little bit different than the others we've covered this past week or so. And that's mainly just where the share price is, where it has been, and kind of where it trades at. So, of course, you're still going to get that 5% dividend yield, like I mentioned. But if we're just covering where this stock was and what it's done, it is a bit strange. So, 2008, 2009, whatever it may be, you've done very well since then. Not too surprising. Almost every company has. Of course, some went under. The ones that have survived and thrived, and ones we're talking about, generally they have larger market caps. They've done well since lows in 2009. That's not surprising anyone. But that run up from 2008 to like 2015 was pretty incredible. Even from them to here, considering the dividend yield, what REITs do, it's been very good. But if you bought in 2015, 2016, you're actually, at least on the share price, down. Overall, you are up once you factor in the dividend, but it's still not performed very well. You would have much preferred to buy something like the S&P 500. It's not great. It still would have outperformed things like cash by a pretty large margin, but it's just not the best performance. But one thing that I'm really focusing on, obviously they were very low in 2020, in the 60s, 50s even. That was a bit of an outlier, obviously a good opportunity to buy in hindsight. But one thing I do notice is, unlike Vici and unlike Realty Income, this stock trades a lot more like an average stock or like a tech stock. Now, obviously not as extreme as a tech stock, maybe more like the S&P 500 itself. When we look at Vici, when we look at Realty Income, when we look at Cigna Group I covered on this channel, they don't follow what the tech pattern does, right? They were hitting highs in 2021, tech was. In the bear market lows 2022, 2023, they were lower. That's what we see in Simon Property Group. And then obviously they've had a huge run this last year. That's what we see in the S&P 500. We were hitting highs in 2021. We were lower. We were kind of flat, maybe up a little bit. And then we've had a really good run over the last year, year and a half or so. So Simon Property Group gives you the REIT, but it trades more like an average stock, less like a value stock. Now, that doesn't mean this sucks. If you hold Simon Property Group, probably many of you do. That's fine. Hold through it. I like it. I like it as diversification. I like the dividend yield. It's a great company probably to hold long term. However, if you are a person, maybe like me, and you have no money in this currently, this is one I'm eyeballing. I'm eyeballing it very, very heavily, because if you want more exposure to dividends, you want more safety there in the bear market, you don't like buying into tech at lows. I understand that. I like doing that, but I'm a little bit kooky sometimes. Not everyone has that risk tolerance. Not everyone feels comfortable with that. However, if you're buying into, Cigna, going to do well in a bear market. If you're buying into Vici and Realty Income, things like that, this would be a good one to buy when it's lower in a bear market, because we probably, unless the company itself is doing phenomenal, and that happens sometimes too, this is a company that seems to trade like the general market. And in a bear market, I'm not talking full-on recession, but just a slower time, like a down period we saw in 2022, 2023, that wasn't a full-on recession. At least it's not categorized as such. Certainly not something like we see in 2008. I mean, it fell, but that to that compared to that, it's just different. This would be one I am eyeing very heavily to buy if it dips in a bear market, because you're going to get that dividend yield. It's going to be higher because it's going to be lower, versus if you're trying to buy other REITs, it might, those might be higher or flat or whatever it may be. You might be able to get in this one at a discount. Now, outside of that specific strategy that I think may work, maybe it doesn't, who knows? That's just kind of theoretical. That's how I might look to play this. But as a company itself, as a stock, it's really pretty good, even at these levels if you're holding long term. Well, why is that? When I'm looking at dividend stocks primarily, and I'm not saying when I say dividend stock, you can't get share price appreciation. Clearly, long term you can. But I'm really looking for three things. One for me is diversification. I own a lot of tech. I understand tech. I got a degree in tech. I currently work in tech. I understand tech pretty well. I do. So naturally, tech performs well in the stock market. I'm going to own a lot of it. So not that I don't own any REITs. If I'm looking at Simon Property Group, it's diversification. Even though I love tech, I understand it, I don't want to be 100% in tech, even with a long-term outlook, because if I put money in value stocks that maybe aren't doing well in a bull market or are doing fine, mediocre, during a bear market, they're going to do very well. And I can sell some of that if I really, really need the money for some crazy emergency that my emergency fund couldn't cover. I could use that money, like in a worst case scenario, but also I can take that money and put it into tech, which is doing poorly in a bear market. So I like diversification for that reason. For me, this would be some level of diversification. If you own like 99% REITs, obviously for you, that does not apply. But I'm assuming most people watching, even if you do own Simon Property Group, isn't the case. Second thing I'm looking for, long-term history of the stock. I like to see chart go up, even in REITs, even in dividend stocks. Chart go down, it is more risky, clearly. Obviously, past performance is not a 100% indicator. However, it's a very good one. It's probably going to give you a good understanding of where this company has been, where it's going. So, not that you are expecting a lot of share appreciation from a REIT, but okay, does it match inflation? How long has it matched inflation? Okay, 2008, it's matched inflation. Certainly since the lows there. Since 2000, it's matched inflation. 2015, it hasn't. So, but you can maybe write that off as that was fairly overpriced then. I wasn't looking at this stock back then, so I don't really know. But we're looking at PE. That's fine. I don't look at PE too much for it. It's okay. But yeah, if you're looking at long-term track record, and then the last thing obviously I look at is dividend yield. Just over 5%, that is good. I'm looking for a solid dividend yield, but also not crazy high. Once you're getting in that 7 to 8+% range, there's plenty that can do it, but that should tell you this is riskier. Because if you're taking that much money year over year out of the business consistently, that's what you're expecting. Now there's some that do it. Maybe you get a great year, like maybe something like Maine, probably a good number of you do this. I think they average around 5. Like, hey, we're going to do 5 every year. But then they often do better and they give out 7+. That's fine. That's a little bit different. But in something like certainly a REIT, if you're getting higher than that, you can do it. And if you understand it, I don't understand the REIT industry quite that well, where I would feel comfortable doing that. But then also, if it's 3%, okay, what is it appreciating? If the share price is going up, let's say 6% every year, okay, well, 3% really isn't that bad, but you have to factor in that dividend you're getting from it is less. So that's what I'm looking at for dividend stocks specifically. Simon Property Group hits all the marks for me. It's over 5%. It's not crazy high. It's not super low. Over long term, it has appreciated, and for me, it's diversification because I own REITs. I don't own, 50% of my portfolio REITs or anything really near that. Just some final thoughts, guys, talking about the market in general. Try not to freak out too much. Yes, position yourself for whatever market you think you're going to be heading into, but try not to freak out too much. Certainly with retirement stuff, if you're under 40, 45, even 50, the odds that your generalized S&P 500 ETFs are going to be down in like 10 years, even 7 years is very, very, very unlikely. It would be a historical anomaly at these PE levels. Obviously, we've seen things like the NASDAQ in 2000 still down or flat 13 years later, but the PE levels on that, if I'm understanding correctly, were ridiculous and significantly higher even for the S&P 500 being in the mid-20s. Yes, that's historically high even today, even after this retrace. But if you're talking about retirement money, don't freak out. Remember to hold through that. Buy more when it's lower. If you want to position other money for a bear market, of course, do that. I'm all for that. That's all I really got for this video, guys. If you enjoy, like and subscribe. I'll catch you next time.